this way. It's an experiment. I'm Steve Clemons. I direct the American Strategy Program, and hello to the folks at the Washington Note that are watching online now. We're going to do two events today back to back with a 15-minute break for everybody to run and grab a cookie. This morning we're honored and privileged to have a very good friend of mine, Richard Vague, with us. I'm going to say a few words about Richard, but I wanted to let those watching live also know that at 12:15 we're going to be joined by former envoy, presidential envoy and Ambassador James Dobbins, who essentially organized and convened the Bonn Conference in Stabilizing Afghanistan, talking about his new book, After the Taliban, really the future of nation building in the United States. That Bonn Conference was very interesting because of the inclusion of Iran in the process. People think we haven't negotiated with Iran for a long time, but there was a clear case where that actually wasn't true, and Dobbins was the guy who did it. So we'll have him here. And I thought as a preamble to the Dobbins meeting, it would be very interesting to talk about what's going on here and how what's going on over there in terms of the wars that are going on affect sort of home base. Richard Vague is a, I should say formerly conservative. He's kind of conservative. When I first met him, he was really conservative. He's loosened up. He built the largest credit card business in the United States when he was the founding CEO of First USA Bank. He's been long involved, and he's like many of the people who found themselves involved at the New America Foundation, particularly in the foreign policy sphere. He's someone who sort of woke up and realized, you know, the United States is not held in the same esteem that it once was abroad, and that we're not demonstrating the same respect to other nations abroad. And he founded an organization called AmericanRespect.com. It's on the website, and we basically conspired at one point to sort of figure out how can I reach, and this will sound bad, the country club set, the guys that are out, you know, shooting golf with small businesses, Rotary Club, Lion Club memberships, and help them to understand, come on in, some of the things that are going on. John, can you scoot over for Steve Muffson? Everyone's Steve Muffson with the Post. And we,
Sorry.
no, good to have you here, Steve. In any case, when we did this, Richard wrote a brief, largely from his own perspective, not a policy wonk from this, but someone thinking about, from the many things he has read and sort of thought about terrorism and how other societies. He wrote a brief for essentially his country club friends called Terrorism, a Brief for Americans. And we distributed this thing to thousands of people around the country who were not normally part of the New America Foundation groupie crowd, or who were not normally addicted to policy websites and those kinds of things. So we've become very good friends. Richard is also a political supporter of Joe Biden. I mentioned that for important reasons that might be interesting today, maybe not in the next couple of days. But he's also someone who worries a lot about the economy. Now, I know it's controversial to sort of talk about the war and the price of oil. There's a friend of mine in the audience who will unveil himself later, I'm sure, who disagrees with the thesis that the war in Iraq, the wars abroad, and the potential of war with Iran have significantly affected oil prices. What's interesting is he has the view that if we do ratchet up further with oil, given where the price of oil is, even though it's come down, we're looking at a real nightmarish situation. I'll let you decide to share that with us later if you like. But Richard's looking at the legacy of what high energy prices and what the rising costs of inflation are in a society, and he's going to share that with us in a program called How the War is Driving Oil Costs Up and American Families Down. So without further ado, let me invite Richard Vague to share with us his slides and PowerPoints on his thinking about the economy, and we'll be back for discussion with him. Richard Vague. Thank you, sir.
Thank you very much. It's a real privilege to be here. You know, even though the price of oil has backed off or come down in recent weeks, viewed into a historical lens, oil prices are still up an alarming rate since April of 2003. Now, blame is being laid at the feet of rising demand in India, China, biofuels, speculators, and a host of other supposed culprits. But central to the real explanation is the Iraqi war and the resulting weak dollar and risk premium in oil prices. You know, there's a lot of headlines. There's a New York Times editorial or op-ed in the last couple of days talking about no end in sight. You know, our economy can't get better. Well, our thesis is that our economy cannot get meaningfully better, thank you, sir, cannot get meaningfully better until we stop spending the massive sums we continue to spend in Iraq. Now, on the eve of the invasion of Iraq, oil prices were at $28 per barrel. You can see what has happened to oil prices since the invasion of Iraq. And even though all the data I'm going to show you today is as of August 5th, but if I updated it to the present day, it's not going to be appreciably different from this. But oil prices, even with the backing down that has occurred over the last few weeks, oil prices are still up almost 4 times over the level they were in April of 2003. And it's not just oil. Essentially all commodities have seen this same increase, and all of them tied to essentially the same date. Here we see corn prices that are up about 2.5 times since the invasion of Iraq. Again, even taking into account the recent backing down. Wheat prices up 2.5 times. Soybean prices up 2.5 times. We could look at just about any commodity, gold, dairy, you name it. The phenomenon is more or less across the board. Now, the most oft-cited reason for the rise in oil prices is the quote-unquote global rise in energy consumption. And proponents of this explanation are very quick to point out that India's oil consumption was up 6.7%, over the previous year. China's oil consumption was up 4.1% over the previous year. In fact, I did a little exercise in putting this paper together. I asked a lot of my friends from every walk of life, with the price of oil having gone from $28 to over $100, what do you think the year-over-year increase in global oil consumption is? Well, the answer is 1%. The increase in oil consumption in 07 versus 06 is 1%. And in fact, in the first half of 08, we're seeing that consumption in the United States alone is down 4%. Consumption in oil in 07 and 06 were down over the previous year slightly. Oil consumption in 07 in Japan was down 3.5%. In the European Union countries, it was down 2.8%. Here you can see oil consumption increase over the last 10 years. Here's 10%, here's 1%. The typical increase in oil consumption year over year have been averaging about 1%. And in fact, when we get the 08 number, it will probably be very close to 0%. Now I'm going to put these two graphs together. And you can see that over half of the increase in the price of oil has occurred during a period of decelerating demand. So what we're contending is that the primary cause of oil price increases can't be supply and demand. Supply and demand are obviously always a factor, but can't be supply and demand. Now, the punchline is oil prices are up almost 4 times in a period when demand growth has been soft. Now, some commentators have tried to explain increases by suggesting that there's a production ceiling, that there's some magical barrier at 85 million barrels a day, which is global oil consumption. But as we've gone, I recently was on a trip to Saudi Arabia with Steve, talking to Saudi Arabian ministers, and they have the capacity to bring a couple of million barrels of oil production on very, very quickly. We see in a lot of places an increase of only 1% per annum in oil consumption is only about 850,000 barrels a day. U.S. consumption alone has dropped that much in the last 6 months. So why are prices up? Much of the discussion about oil prices has focused on our dependence on foreign oil. And I completely agree that reducing our dependence on foreign oil is a good thing. You know, it's going to bring over time strategic benefits, risk management benefits, environmental benefits, hopefully, demand side benefits. It's something we should do. If you were in a business and you had too much dependence on one supplier, that's a bad practice to begin with. So risk diversification. But our dependence on foreign oil can't be the cause of price increases, because our dependence on oil is no different today than it was in 2002 and 2003 when the price of oil was $25 or $30 a barrel. Those two concepts, the dependence on foreign oil and the price of foreign oil, are only loosely linked. I think the primary place to look is the weak dollar. Since the invasion of Iraq, the dollar has declined markedly against the euro. In fact, it now takes 40% more dollars to buy the same number of euros. Let me show you right here on this graph. The dollar and the euro has kind of bounced up and down, but they've been more or less in this 1-to-1 ratio up until the spring of 2003. Since we invaded Iraq, the euro has ascended to a 35 to 40% premium over the US dollar. Now let me show you another slide. This is the price of oil in euros. You know, not by coincidence, in the spring of 2003, oil was $30 a barrel and oil was 30 euros a barrel. Since spring, oil has increased in the euro as well, but only up to $70 or $80. Another way to say that is, if our dollar had not weakened versus the euro, the price of oil in dollars today would only be about $70 to $80 a barrel. We'll come back to the subject of the weak dollar in a few moments. The second place to look in terms of the decline or the rise in oil prices is risk. The market price of oil began rising immediately after the invasion, and that, we would argue, has largely been as a result of the risk premium associated with an expanding Iraqi war, a potential Iran war, any number of other conflicts that could occur. Steve mentioned Joe Biden. Joe Biden has been saying that the risk premium alone in oil prices is in the neighborhood of 30 cents on the dollar. At today's oil price, that's a risk premium of $30 or $40 a barrel. Even if you don't buy that, it's something. It's $10, it's $20. To this idea of a risk premium, we would add both speculation and hoarding, which are both very widespread, of course. When we add these factors together, we believe that these factors account for, on the low side, $20 to $30 per barrel of oil. Without these factors, without the weak dollar and without the risk premium, we believe that oil would be well below $100 per barrel. A stronger dollar alone probably brings the price of oil down to $70 or $80 a barrel. Take a risk premium out, and you are arguably very near where we were prior to the invasion. Certainly no higher than $50 or $60 a barrel. Now, excuse me. Now, why is the dollar weak? One key reason: easy money, or what the economists would call an expansionary monetary policy, which is an increase in the money supply in excess of economic growth itself. The U.S. last entered the trap of monetary inflation in dealing with the massive spending in Vietnam and the effects of the oil embargo, LBJ's famous guns and butter. And I've been reading Nixonland, which I recommend. And, you know, it's 1966, and Nixon is already attacking LBJ under, on the topic of inflation and the fact that the Vietnam War has created inflation in the United States. This period, from the mid-60s to the early 80s, taken as a whole, was the second worst period in the U.S. during the 20th century, and combined both inflation and a recession, stagflation, as it was called. It took Federal Reserve Chairman Paul Volcker in his tightening of the money supply, and for those of you who were there and in their business careers as I was, you'll remember that interest rates went above 20%, but it took that action to overcome inflation. More recently, the Fed has again been easing money. The fact that real short-term interest rates have been negative for most of the decade, in other words, interest rates are below the rate of CPI, is evidence of this. Kind of as an aside, an important aside, it's been this negative interest rate scenario that has fueled the rather large excesses that we're facing right now, especially the current real estate crisis. Now, if you study the numbers, if you look at M2 versus GDP from the period of the mid-80s forward, or the mid-90s forward, you see that the Fed has acted in this manner for a variety of reasons. First, major evidence of this comes in the internet crash of the late 90s and 2000. The next major instance of it was the aftermath of 9/11, when M2 grew 10%, while the U.S. economy actually grew 0%. But the main current reason the dollar is weak has been financing a $1 trillion war without raising taxes and without raising interest rates. Now, it shouldn't have been unexpected. I can remember a lot of us were opposed to the war in 2002, as there was beginning to be a lot of talk about it, and there's a lot of reasons to be opposed to the Iraq War. But one of them was that it was going to wreak havoc with the U.S. economy, and it has. And frankly, it shouldn't have been unexpected. Governments, kings, and countries have routinely used inflation to pay for wars. For those of you who are avid readers of history, you know that, go back a few centuries and kings are clipping coins and taking the silver and gold off the edges of coins and melting it to create new coins. And that's a way to inflate the currency. During wars like the Civil War, it was more blatant. It was just printing more paper. Why do kings and countries do this? So that they can pay for a war without raising taxes and without having higher interest rates over the short term, and pay back debt in the future with cheaper dollars. Now, some discount the idea of inflation, pointing to low CPI in the absence of wage pressure. In fact, I was at a conference 2 or 3 months ago where a former head of the Council of Economic Advisors was asked that question, aren't you concerned about inflation? And the answer was, no, look at CPI. We shouldn't be concerned about inflation. However, CPI is a lagging indicator. CPI movements actually lags actual monetary supply growth by as much as a couple of years or more. And wages lag even further still. Once inflation manifests itself in these numbers, and our recent numbers have been troubling, 9.8% PPI growth, 5.6% CPI growth. Once inflation manifests itself in these numbers, the chicken has long since flown the coop. Now let's talk about inflation for just a few minutes. High prices don't cause inflation. Inflation, monetary inflation, causes high prices. Most people think about it in the other direction. It's been 20 years since inflation was tame, and it feels to me like people have kind of lost this lesson. They think if a price rises, that's what causes inflation. No, expanding the money supply is what increases inflation. Monetary inflation occurs when money supply growth is in excess of GDP growth. With monetary inflation, price increase occurs even if there are no changes in supply and demand, simply because there is more money chasing the same number of goods, and it follows that it takes more money to buy those same goods. Now, this war has been expensive. You know, I've just contended that one of the key reasons that we've expanded the money supply the way we have is that we've been financing a war. Many folks have contended that this war isn't that expensive. But if you get into the data, if you spend time rolling up your sleeves and looking at it, this is now the second most expensive war in U.S. history, adjusted for inflation after World War II itself. And frankly, the estimate that I've included here, the kind of 800 billion to $1 trillion estimate, is the lowest number you'll find. There are others who put this number at a far higher level. And some independent analysts have come up with these larger numbers. And by the way, $1 trillion comes in the context of the U.S. being at a $13 trillion economy, and our annual budget being a $3 trillion annual budget. So $1 trillion expenditure of war is massive no matter how you measure it, against GDP, against the budget, as a percentage of overall economy, etc. Some independent analysts have come up with higher numbers by going in and looking at things such as the emergency supplemental spending and adding that properly back into the analysis, or looking at defense-related expenditures that don't necessarily end up in the defense budget. Some analysts have put our current defense spending as high as $1 trillion annually. In any event, whether you buy that argument or not, our current defense spending today is larger in inflation-adjusted dollars than at any point since the end of World War II. Now, here's one of the most important slides I'll show you, and it's U.S. debt. And you can see that prior to our invasion of Iraq, our debt had been high. Our debt, some folks would say, had already been alarmingly high. But it was rocking along at about $4 to $5 trillion. Since the buildup for the war, U.S. debt has increased from a little over $5 trillion to almost $10 trillion. So for those who are contending that the expense of this war is low, you're going to have to come up with some other reasons why our debt went from 5 to 10 trillion. It's at record highs. And the other thing that we're going to suggest here is that evidence of the expanding money supply is that we essentially doubled the U.S. federal debt while interest rates remained low. And we would argue that it's difficult, if not impossible, to do that unless you're incorporating a very expansive monetary policy. Now, one of the key differences I'd note as you study this war versus others is that there really haven't been financing strategies to deal with the expense of the war, most especially tax strategies. We've actually fought this war and paid for this war in an environment where taxes have remained the same or been pulled down. So how do we reduce prices? How do we strengthen the dollar? You know, I was living in Texas in the 70s and 80s when we had the last period of high inflation and high energy prices. But in 1986, oil prices dropped from $40 a barrel to $9 a barrel in a matter of months. And that was not as a function of reduced global demand. That was a function of the work the Fed had been doing for a number of years under Paul Volcker to strengthen the dollar, to rein back money supply growth, and global energy costs, global commodity costs came tumbling down. And it created basically a 20-year period of excellent economic performance in the United States in this category. One little side note that I would make is that oil prices came down in 1986 and the Soviet Union came down in 1989. I mean, I would argue that it was that fact more than defense spending buildup that brought the Soviet Union down. So what do we do to reduce prices? Two very straightforward things. The first cure for an overexpanded money supply and a weak dollar is more disciplined money supply growth, which normally results in higher interest rates. But that's a tough thing to do. Right now, we're having what is probably the worst real estate crisis in U.S. history, certainly aside from the Depression itself. Rising interest rates will exacerbate that problem, so the Fed and the U.S. government really do have a genuine dilemma how to balance interest rate management of the economy versus working through the remaining problem in the real estate crisis. So it may not be that there's a lot to do there over the short term. Some folks have been arguing that even symbolically, a quarter-point increase in short-term interest rates or a half-point increase in short-term interest rates would help a lot. Well, that leaves one other thing, and that is reducing federal expenditures. The most effective way to ease pressure on financial markets would be to dramatically reduce our expenditures in Iraq. This savings would be a powerful antidote to high prices, deficits, and a host of other ills. In fact, I would again submit that it will be impossible for our economy to get appreciably better without that change. In other words, if we are concerned about the economic well-being of American families, if we are genuinely concerned about the economic well-being of American families, we'll get out. What about speculators? Aren't they to blame? Speculators always pile on when there's a dramatic upward movement in the prices of any asset class, oil, gold, and routinely they get a disproportionate share of the blame. But as one economist has said, quote, there is a tendency for rational investors to sit on the sidelines and allow an overly enthusiastic market to go unchecked for a while, end quote. And George Soros has said, in any period of speculation, quote, there will come, quote, a moment of truth when reality can no longer sustain the exaggerated price expectations. In other words, there's a period where speculators need to watch out. Keynes said, profiteers are a consequence and not a cause of rising prices. Here's our final punchline today. Supply and demand factors, while of course relevant, alone will not cause price to return to their pre-invasion levels. Inflation and high spending on the war are the culprits, the most fundamental causes of high prices. We have weakened the U.S. dollar and the economy by financing a massive war on the cheap. And things will only truly get better when we significantly reduce this military spending and act to shore up our dollar. Thanks very much.
Richard, thank you. Let me open the questions. I mean, I'm very depressed not by your presentation, but by the implications when I think about the political positions and statements of Obama and McCain. So, for instance, if you were to talk about withdrawing from Iraq and look at Senator Obama's various scenarios, one scenario has a residual force being left in Iraq of 60 to 80,000 troops. He's talked about increasing the size of the military, the permanent military, by approximately another 100,000 fixed military, which I think most people say in terms of real cost, not derivative long-term costs, is about $30 to $40 billion a year. And when you look at the scenarios, because Barack Obama does talk about getting a dividend to spend on a lot of social programs by shutting down the Iraq side, but I sometimes wonder if that's true. If you look at John McCain's side, where he's been flirting with the notion of a draft recently, we know that his notion about, or his own thoughts about forward projection of power are fairly robust. And so to some degree, the scenario that you lay out of what you think is needed to get a correction is represented in neither political campaign. That's one issue. The second is that all of the scenarios you talk about in terms of raising interest rates a la 1980s, early 1980s period, are an incredible gut punch to the middle class. And so I'm wondering, if you're an investor, you're a smart businessman, do you buy your own, would you invest in your own prognostications of what's needed, given the other realities out there?
Well, first of all, I have invested in my own prognosis on the economy. Yeah, one of the encouraging things is if you really study carefully the delta in money supply growth versus GDP in the period of the 60s through the 80s, you'll realize that our monetary expansion is not as great as it was then. It's getting there, but it's not there. The sooner we act, the less of an interest rate bump we will have to deploy. The longer we let this thing drag on, the stronger the medicine will have to be. So I'd say, moving sooner prevents the kind of draconian action that Chairman Volcker had to incorporate. Now, on your observation on Senators Obama and McCain's policies, yes, I don't disagree. And in fact, I think Vietnam is instructive. From the time that the Vietnamization program was put in place, the decision was in essence made, we're getting out and we're turning it over to Vietnam. It took us 5 years to get out. That's not encouraging. And if you believe Melvin Laird, who was the architect of Vietnamization, what he said is that he had to overrule the generals and the president at almost every step along the way in terms of the number of troops that were being brought home. It's not encouraging.
Interesting. Let me open the floor. Greg Priddy. There's a microphone, Greg.
Greg Priddy, Eurasia Group. I'll phrase this as a question, but let me first explain the premise of it a little bit. And the question is about how would you answer the argument about what's frequently called forward fundamentals?
Forward fundamentals?
Yeah. When you look at the supply curve moving forward, at the same period of time that you've had this shift in the dollar, and I agree with your argument on that, I just don't think it's the only factor in play, but after about 2002, you've had this big shift in assumptions about how high Saudi Arabia could go. Like if you look at the Department of Energy forecast, the conventional wisdom on that has shifted downward. And then a pretty grim supply picture in a lot of countries as a result of government policy or security issues, Iran, Iraq, Venezuela with Chavez, Putin's Russia. And you put all that together, the market, there's an argument that the market would be going up anyway, maybe not as much as it has, just because it needs to reach a level that destroys demand and makes it clear. Clearly it overshot when it got into the 140s, but how would you respond to that?
Well, I agree completely. I mean, there's always a lot of factors around supply and demand, especially on a market that's this large. And so it wouldn't have surprised me at all if, because of supply and demand issues, oil would have gone from $28 to $40 or $50 or $51. In fact, I often get behind in my Business Week reading. And so it was 2005 or late 2004 that I was going back through an old stack of Business Week, and the headline on one of them was, "Can the world live with $45 a barrel oil?" So, yeah, supply and demand factors could have created a doubling of world oil prices. They couldn't have taken us to 100.
Well, I'll share one quick interesting vignette in terms of sort of relative place in this. We had a dinner. I'll tell you, it was Yashka Fisher. I think I'll out Yashka. And Yashka, it was a small dinner, and he was telling, he's one of the few European leaders that actually met the supreme leader Ayatollah in Iran, Khamenei. And they had a weird exchange, and the exchange went something along the lines of this. I put this in my blog, where Yashka Fisher, or Khamenei was telling Fisher that the reason that he knew that Iran would eventually prevail over the West, the United States, Europe, given any potential collisions, was that our democracies couldn't withstand $140 a barrel of oil. And I think it was, 30 or something of that sort at the time. And Fisher replied to him, allegedly, saying that you underestimate democracies. What's interesting is we have that, we've surpassed that. It's interesting to look at the fact that I don't see protests in the street, but you do see economic consequences. But I want to push Greg. Greg is one of the really great analysts on oil and energy in Washington. And can I say that you're one of the people who helped my preamble? You don't believe that the potential of the Iran war is really built into current prices, which makes you worry about a conflict. Is that not right?
Yeah, I think that's definitely the case. And when you look, a big piece of evidence for that is when you look back at when the NIE came out in early December last year.
Right.
There was this big collective sigh of relief, and you didn't really see a price impact.
You didn't see a price impact of the NIE.
Yeah,
That's
but
very
I certainly, there's a lot of momentum trading that goes on off of headlines related to Iran. If you look at June 6th with Shaul Mofaz's comments, I mean, part of that was the dollar that day, but part of it was also that headline risk. But when you talk to traders about it, there is a lot of skepticism that it would actually happen.
So as an analyst, and I don't mean to, I'll get to other questions, but as an analyst, I had Tom Fingar, the chairman of the National Intelligence Council, who did that, presided over that estimate. If they did what's called a memorandum to holders, an update of that estimate now, and they came out and said, you know what, Iran's back in the nuclear warhead production game. What do you think, in your estimates, would happen to the price of oil if that were to come out?
That would probably be enough, if they contradicted what they came out with last year, to have some risk priced in. It would certainly be a headline risk that would drive momentum. But I think there is just this it's such a big, as they say in the risk industry, a fat-tailed risk, one of those things that's just almost unthinkable. And people are willing to look at it as a driver of momentum, but they kind of tune it out as something that actually could happen.
Thanks. Robert Sharetta.
Thank you, Steve. Robert Schroeder with International Investor. Let me really focus back on your talk, if I could. I think that the people that you did mention among those that studied this area were Linda Bilmes and Joseph Stiglitz, did the famous study. We actually interviewed them just before they released the study in about 2006. One of their points that they made, in addition to a very modest calculation that the price of oil also will contribute to what will ultimately be a $3 trillion expenditure for these conflicts, was the fact that they also assigned a value to the price for borrowing these funds, which are largely, as we know, borrowed on the world markets. So I wonder if you could just comment briefly if you think that's another fair assumption. You didn't mention it very much in your presentation. And finally, there's one other, if I can sneak one other question in, and that is, frankly, we do see that the higher price of oil is ultimately helping a number of other nations in the world, Russia, Iran, already mentioned, and Venezuela here, and what that will do to complicate our further foreign relations.
Yeah, I mean, it's my view that if oil prices were nearer to pre-invasion levels, you don't have Russia doing what they're doing in Georgia right now. So I think the fact that our, a series of actions mainly related to weakening dollar and increasing risk have put a lot of money in a lot of pockets that will end up exacerbating the destabilization of what's going on in the world. Now, back on your comment on Stiglitz and that book, I actually do. I've studied that pretty carefully, and I've banged on those numbers pretty hard, and I think, most of what they put in there holds up very, very well. And of course, the interest cost of the war is a real cost. If you aren't funding it, it's somewhere, and probably it's in the pockets of consumers, earning interest in a savings account or paying down debt or something. So it is a very real cost.
For the record, Robert, I told Richard to take that Stiglitz reference out. in part because I think while it has a compelling nature, you don't need a seemingly exaggerated, whether it's exaggerated or not, and he's saying it's not. The fundamental issue is I don't think that you need that. You can work from the conservative estimates of the cost impact of the war and look at other sort of net losses to the country. There are lots of other things you could do. You look at the collapse of the Doha round. You could look at, a sort of pushback, if you will, of the United States on a lot of other fronts to imagine what costs you have. But I don't think you have to go down that route to make that argument.
At the time for these projections, and they're looking more and more real.
Yeah, I mean,
That's my only
if
point.
the war only cost $820 billion, you got a lot of explaining to do as to how you grew $5 billion here. Yeah.
I'm John McCormick with the Energy Policy Center. I certainly agree with your sentiment about the impact of America on the Iraq War, but I don't think your presentation is complete because you really didn't focus on the world supply 2004 to present, where it's basically plateaued. And I look at the increase in consumption in the Middle East countries, and it's pretty staggering. Between 2002 and 2007, Saudi Arabia's increase was matched China's increase. Okay, Qatar and other Algeria, they're increasing their electrification, and it's in part powered by oil and natural gas. And certainly, natural gas tracks the price of oil. So I don't see where bringing down the price of oil is going to help this situation because it's going to cause people to hold on to their SUV
So the point is that
and in
global
fact buy
production and
more.
global consumption are really tight, and that
Very tight,
and that
extremely
1%
tight. Yeah,
growth could still be a tilting point.
yeah. I think the demand in the producing countries who are now accruing so much wealth and they're spending it so rapidly on their own goods and services is going to push this demand thing, and we're going to continue. But again, could you address how reducing the price of oil affects climate change?
Let me take those issues separately, and I with all the countries that are seeing high levels of consumption of oil growth, the world's consumption still only increased 1% in 07 versus 08. 1%, 850,000 barrels. It's a low number by any measure. And I've been studying, I don't have your expertise, by any stretch, but you look at, other markets, a 1% change in consumption and production is low. It looks like it'll be 0% this year. And yet oil prices are still 4 times higher than they were in April of 03. So my suggestion is not that supply and demand doesn't have an impact. Of course it does. Does it explain a 4-fold increase? No.
And climate change?
Hey, I don't have any.
This is where his conservative streaks come in.
No, I don't have any particular expertise in that.
Steve Mopson.
I just wanted to pile on the supply and demand issue because, you say it's a modest increase in demand, but I think given the fact that prices have doubled or quadrupled since 2003, the fact that demand is increasing at all is just amazing. And I think also you made a historical.
Pardon, could you repeat that?
The demand is
The fact
increasing
that
at all.
demand is increasing at all is, I think, remarkable given what prices have done. I wouldn't see the slow growth in demand as a necessarily positive indication about the oil markets. I think it's a demonstration of what the whole problem is with the oil markets. It's very inelastic. You can have a doubling of price with virtually no impact on consumption. That wouldn't be true in any other commodity or good.
But do you think that's still true, Steve? An interesting person to talk to is
So
Dave
now
McCurdy.
We're having a slight decrease.
Right.
And, it remains to be seen how long that'll go on. Remember that in the 80s, contrary to what you said, there was a 20% drop in demand in the United States, although it didn't take 1 year. It took about 4 years to take place. So I think we still don't know exactly where we're going to end up, but I do think that the supply and demand question is more important.
There was a 20% drop in oil demand in the United States in the 80s?
From 1979 to 1983.
There was a 20% drop in
20%. So I think, we have a long way to go and we may get there yet. And it may be that gasoline demand has peaked in the United States, and that's another whole issue. But I still think we're at early stages, and I do think that the supply and demand issues
By the way,
are
the
important.
data.
And I would also just say that I think that the supply and demand picture is an enabling factor for all the other things you're talking about. If the margin between world supply and world demand were the same as what it was in the mid-'80s, we wouldn't care whether we were going to invade Iran, because the excess supply was so much greater than the entire Iranian production. It's that small margin which is
How tight it is.
which helps enable speculators, which makes the risk premium higher, because you can't afford another supply disruption. So I guess my point is that I do think that supply and demand picture questions, while I'm not arguing that we were emphasis about these other factors, I do think it's the supply and demand that helps enable these other things to take place. And to some extent, we still don't know how big a correction we're going to get out of these high prices we've been having. But that impact will be important in how these other things play out going forward, I think.
Yeah, I mean, I want to repeat. I don't discount supply and demand. I'm just saying, if today our dollar was at 1-to-1 with the euro, the price of oil would be $70 or $80 a barrel today.
Well, I'm not convinced about that, because
We had the charts up here.
Is the question what the price is in dollars, or is the question what the oil price would be in a currency, a basket of currencies?
I'm just talking about dollar versus the euro.
But maybe the important thing is what the oil price is in a basket of currencies, including the euro. And if the dollar were weaker, the dollar were stronger, maybe that the basket price was higher overall.
I think that, yeah, I see what you're both saying. I also think that there is a group of folks that says that the decline of the dollar and what's driven it has in fact helped drive some sort of reshifting of currency positions in the world, that the dollar-denominated oil market, et cetera, has exacerbated this to some degree in terms of global currency markets. So
I'm just
yeah.
not sure what the cause and effect is, right? I mean, the high oil prices also weakened the dollar, right?
I mean, in just the same sense.
$700 billion
Right.
out of the country without some impact on the dollar.
I mean, some of us outside of the oil and war issue have been worried about the impact of the current account deficit for a long period of time, sort of approaching 7%, and the accumulated effect over that time would have some sort of. Kathy Mann at the Institute for International Economics has been, very strong sort of neoliberal perspective, but nonetheless says there's a fundamental impact. That was perhaps another enabling factor that preceded a lot of the factors that you're talking about, in addition to tight supply and demand markets that lead to other issues.
Well,
So,
and I think
but I
what-
do think that there was a preamble to a lot of this, which had to do in economic. I mean, Ken Rogoff wrote I think one of the most important pivotal op-eds in the Post at one point, called it a debtor's empire, that was saying how in the world, and then it raises the geopolitical question. The geostrategic question is essentially, just to be crude, the deal America had with the world, essentially in sort of deploying 750 military installations around the world and deploying troops and whatnot, is you're providing a global public good of security and stability, but you're exacting terms of trade with the rest of the world, which were highly beneficial to the United States. And the most important of these were oil, cheaper than water in many senses, if you were to look at Perrier or something. But that terms of trade seem to have come undone, in part because of the Iraq War, which raises other fundamental questions of what's driving what behavior. Is that fair? Still cheaper than water. Yes, Kunio Kikuchi, if you can get this. You need the microphone.
Excuse me, sir. Oh, thank you. I'd like to just mention that there's another currency, major currency, which you didn't mention.
You're going to mention the yen?
And which is
Yen
your
doesn't matter,
expertise.
Kunio.
And the reason is this, the two have been more or less in parity. Because just as U.S. spends on war, Japan overspends on public works, or let's say government spending, which they could not check. And the accumulated deficit is just as large. Now, The reason why Japan can't check the public spending is because of the vested interests. And I would like to say that the 800 billion or 1.5 billion just didn't go in the sand. It is lining somebody's pockets. And that vested interest might be very difficult. You said for the case of Vietnam War, it took 5 years with very strong intervention by Melvin Laird. Do you think that coming the next 5 years, there's that kind of force in the United States to check this spending?
It's going to be tough because I mean you don't see a lot of people taking a forceful stand for, the way I feel that they should.
So there's no solution.
It's it took kind of like 20 years from the 60s to the mid 80s to kind of deal with that whole thing, dealing with the war, decelerating. It was a very protracted period. And there was a lot of positives that came to the U.S. economy when it finally ended. Now, to your point about currencies, one of the things that I didn't mention but that we've seen is that our inflation of our own money supply, our expansion of our own money supply is creating a lot of problems around the world. We were in Saudi Arabia, and the most bitter complaint we heard was about the inflation in food prices that's occurring in Saudi Arabia because Saudi Arabia keeps its currency pegged to the dollar. And they've had to expand their money supply to keep that parity. There's a lot of other currencies in the world where that's happening. Whether directly or indirectly, they're keeping their currency pegged to the dollar. So our inflation of our own money supply affects the world. And just one minor comment, we had one economist point out, and I think correctly, that we had a little global mini boom because as people were expanding their economy, their money supply to keep it parity with the U.S., they were fueling economic development, short-term boom in their own economies because of that easy money.
We used to measure money supply growth and report it. I used to remember to see it in the front page of the Wall Street Journal. I just don't know the answer to this. Do we not do that now? Are there no good measures of sort of constant changes in money supply? It's out of fashion, or have the benchmarks and the sort of indicators become anachronistic?
It's hard. I mean, I'll talk to the guys at the Fed.
There are no official numbers that are...
There are M2. They discontinued publishing M3, by the way. But you'll get this comment, and it's a valid comment, which is, how do you measure money? There's money out on prepaid debit cards. How do you really measure money the way we used to? But in the days of Volcker, the number we looked at, I think it was every Friday, was the M2 numbers came out. In all the markets were more focused on that number than any other number in the economy.
Mike, did you ever hand up? No? Other questions? Other questions? Yes, Robert, go ahead.
Real quickie. But this goes back to, thanks. Yeah. This goes back to just before the war started. I don't know if everybody remembers this, but really the sanctions on Iraq were doing no good at all in terms of controlling the oil that was leaking out of the country. It was always cited as one of the reasons, if you talk to the traders on Wall Street, as one of the reasons the price of oil was being kept down at the time. There was a lot of supply, and Iraq's supply was contributing to it. With the advent of the war, some theorized that it was really taking that oil off the market more than any other factor that gave, at least the early years, the rise of oil's price, because it suddenly locked up a lot of that inventory. They were no longer able, especially during the conflict and immediately after, it was really in a state of lockdown for a while. And that was a considerable chunk of oil supply for the world.
Final comment?
Pardon?
Do you want to comment?
Thank you for the...
Well, let me before we close and say, one of the things I wanted to add real quick, just in just a couple of my own editorials, is what I do. On the climate change issue, which I think is important, that's not what today was, but I do think it's an important issue of how do you generate prices if climate change is a collective, public goal. How do you drive prices that direction? And I think this also gets to the point that Steve Mufson said. When you look at what is that, that pivot point in the price of oil on consumption, maybe we've hit it, maybe we haven't. But if you talk to the auto sector, they say we've hit it. They're screaming in pain. And while I can't quote anyone, I've talked to a couple of, EVP or higher levels in the auto firms and people involved in trade associations who say, while we're not going to advocate it, what America needs is a price floor now. you need to put in a price floor. If you want to build in that sensitivity and cost, then we need other parts of civil society, because we can't, they'll get executed for this. But you go talk to the auto sector offline, and they said, we need that price floor. That then takes you into some various, questions of how do you then begin pricing policy options that might, in fact, change the climate change side. And at New America Foundation, we have a fellow who's was Arnold Schwarzenegger's guy, Terry Tamminen, who's a good resource on that if you want to go further. But on the other end of these issues, and why I think it is so important to look at, is that we haven't had many discussions, particularly from the business perspective, of looking at what a cost of a war like Iraq has done, particularly when not financed, on a whole variety of other issues. And again, the enabling factor I saw in this is, as you know, I've always been a kind of trade deficit hawk kind of guy to begin with, and was told that fundamentally doesn't matter. The global economy essentially, adjusts and moves and fits here. I read Keynes, and Keynes said, you got to worry about two things in the sort of post World War II economy. You got to worry about currencies becoming a commodity, and you need to worry about big bilateral systemic dysfunction or imbalances that can throw off the system. And we sort of shrugged our shoulders and said those don't matter. We were there before we went to war. So it's been on top of that. I like this notion of what are the enabling environmental factors that took us in different directions. But I do think it's a fundamental question. What I'm bothered by is that when you really parse both campaigns, if in fact you can believe campaigns in terms of policy prescriptions down the road, neither gives an exit to this, which then raises the question of what shocks are you waiting for at some point. So maybe we'll have a discussion about that someday. But I want to thank Richard Vague very, very much for sharing his thoughts with us.
Thank you very much.
Thank you. I want to thank the people that are online, and we're going to take a 15-minute break and then reconvene with James Dobbins.